We're joined today by Dan Roberts, the portfolio manager on the Fidelity Global Dividend Fund. And Dan, thanks very much for joining us today.
Thank you for having me.
I wondered if, to kick off, we could just run through a summary of the investment objective of the Global Dividend Fund.
Yep. So it's an unconstrained approach aiming to deliver a dividend-based total return with an emphasis on capital preservation. That's how we describe it. There are three key features therein. First of all, the unconstrained nature of what we do. The way I would encourage people to think about that is essentially we're building the portfolio from a blank sheet of paper. So we don't take positions by reference to a benchmark or an index. It's a blank sheet of paper. And the upshot of that is that the active share is high, and combined with low turnover, we think that gives us the best chance of success longer term. Now, the dividend-based total return, quite simply, that means trying to strike the right balance between the headline yield, but importantly, the prospect for dividend growth longer term. And then the emphasis on capital preservation, just to bring out the point that it's a very risk-averse approach, albeit an equity-only approach. We're still very focused on capital preservation, and we think about risk, hopefully as our clients think about risk, which is what is the potential to lose money in an investment, and we try and manage that within the strategy.
Maybe expanding on that capital preservation idea, and we're clearly in an environment where there's heightened political uncertainty following the events of 2016.
Yep.
How does the investment process try and deal with that uncertainty?
Okay. I guess the first thing to say is we're not macro investors, we're not top-down investors, so we don't sit at our desk and aim to predict macro events and then try and work out how they might influence asset prices and so on. I guess the events of last year showed just how difficult that is. The few people who got the result of the US election correct would have probably offered you the wrong advice on the back of that kind of view. So we're very much stock pickers, and we aim to manage the risks that you mentioned by picking stocks which have their destiny very much in their own hands, so they're not necessarily beholden to a commodity price or an interest rate differential or so on. And clearly diversification is key as well. So we think 50 stocks within the portfolio gives us enough diversification to improve the overall risk return of the profile of the fund.
Sure. So the fund's just gone through its 5-year track record, yep. and it's produced strong absolute and relative performance over that period. However, 2016 was a strong period for absolute returns, but maybe a more challenging one in terms of relative performance. Yep. And we saw quite a big shift in sector performances within the market. Yep. I wonder what your take is on that sort of big change in emphasis within the market.
Yeah, so it's a fair point. I mean, last year was good, especially for a sterling investor on an absolute return, but partly because of the weakness of sterling. On a relative basis, the second half of the year was much more difficult for us. And I guess we went into that second half where this stagnation, so low inflation, low growth view was quite well entrenched. And then I guess as a result of the shift in emphasis from monetary policy to fiscal stimulus, people started to think about reflation, the re-emergence of inflation, and that drove some really quite violent sector rotations within the market. And I guess we were caught on the wrong side of that, in as much as we weren't very well represented in the main reflation beneficiaries. I'm thinking financials, resources, industrials, and we had decent exposure to good quality companies, more defensive companies, as you would expect, given the objective I just outlined, which was sold off in that rotation. So in terms of where we are now, where that leaves us, those companies that we still own, they're still in the portfolio by and large. They're making good fundamental progress and are now available on cheaper relative valuations. We feel very comfortable about where we sit from here looking forward.
Maybe just building on that sort of valuation case, here's the sort of the change in emphasis within markets and the market moves we saw last year. Has that brought about some opportunities, whether it be in sectors or specific stocks?
Yeah, very much so. And I think that's what excites us most as we sit here today, because that sell-off has been very much indiscriminate. So you probably heard this term bomb proxy. It's not a term I like personally, but it draws in a variety of sectors. Healthcare, telecoms, consumer staples, real estate, utilities. These are all perceived to be bond proxies. Yet in reality, they offer very different investment characteristics. Now, the fact that they've been sold off so indiscriminately, so uniformly, gives us, as fund managers, the opportunity to pick through that wreckage, build on positions that we like, which we think have been unduly sold off, and maybe exit others. So that's what we're looking to do in the portfolio as we sit here today.
One further question, just again building on that, just sort of on the misunderstanding of the sort of bond proxy term. I mean, maybe one particular stock that you think has maybe been sold off because of that, but is attractive.
Yeah, well, there's a variety within the fund actually. So Walters Kluwer is one we owned for a very long time, which sold off about 20%. on that rotation in absolute terms. That's quite a big sell-off. It was never at a premium to the broader market anyway, but during that sell-off it traded at a big discount. It's actually predominantly a US company which stands to benefit from stronger economic growth, so fundamentally it's making progress. Some US utilities we've added to. They are relatively insulated from inflation because of the way they are remunerated. Unilever we bought in that sell-off as well. So these are the kind of things we've been adding to which we think have been, like I said, unduly sold off, and are good companies offering a good entry point now for the longer term.
Dan, thanks so much for joining us today.
Pleasure.
If you would like any further information on the Fidelity Global Dividend Fund, please speak to your investment manager.